Welcome to this explainer. You know, it's often said that change is completely inevitable. And change, well, it gives us a challenge, but also an opportunity to grow and improve. Think about yourself for a second. Maybe not too long ago, your favorite phrase was, "Thank God it's Friday," because you were gearing up for a weekend at parties, hanging out, and just having a lot of fun. But if you're a professional or a student dedicating yourself to mastering some really complex material, like, say, studying for the CPA exams, you might actually find yourself saying, "Thank God it's Monday," because you just spent your entire weekend drooling over your textbooks. That is a massive change in your lifestyle. You've completely shifted from a work-life balance to a work-study balance. Well, guess what? Businesses go through major lifestyle changes too. And those shifts, they have to be meticulously documented. So today, we are diving into the fascinating world of how accountants actually record these inevitable shifts.
So let's really dive into this. What exactly happens when a multi-million-dollar corporation realizes its math is just wrong? Whether it's a completely shifted corporate strategy, a brand new estimation of the future, or just a downright embarrassing blunder from the past, there are some very strict rules for how companies are allowed to travel through financial time to fix their books. I mean, you can't just cross out a number on a massive balance sheet with a red pen and hope nobody notices, right? We have to follow precise, rigorous protocols to maintain the absolute integrity of financial reporting.
Here is the roadmap for our journey today. 1. The nature of accounting changes. 2. Looking forward with accounting estimates. 3. Going back with accounting principles. 4. Changing the reporting entity. 5. Fixing past accounting errors. And 6. The magic of self-correcting errors.
Section 1. The nature of accounting changes.
So, why do we even need to change the numbers once they're already written down? Well, just like that shift from "thank God it's Friday" to "thank God it's Monday," shifting situations in a business requires shifting accounts. Think of a company as a living, breathing organism. Markets fluctuate, products become obsolete, lawsuits happen out of nowhere, and let's face it, sometimes human beings just make simple math mistakes. When the reality of the business changes, the financial statements, which are essentially the mirror reflecting that exact business, absolutely must change so they can reflect the new reality accurately.
To handle all this, we rely on two main timelines. Think of these as our two modes of time travel. First, we have prospective application. This is when we adjust our books right now in the current year and just move forward into the future. No time machine required for this one. Then we have retrospective application. Now this is the heavy lifting. This requires us to literally go backward in time, crack open the old books, and effectively rewrite the past as if the new change had always been there.
Section 2. Looking forward. Accounting estimates.
You might not realize it, but financial statements are packed full of educated guesses. Let's say you previously estimated that 3% of your sales would end up as bad debt, but over time, you realize your customers are actually awesome and they always pay you back. So you drop that estimate down to 1%. Or maybe you bought a company car thinking it would last a solid 10 years, but after driving it around, you realize it's realistically only going to last 5. Or hey, maybe you're being sued. Initially, you thought you'd settle for $5 million, but it turns out it's actually going to cost you $7 million. What about inventory? You thought you could sell your stock above cost, but suddenly the market shifts, those goods become totally obsolete, and you have to write them down below cost. These are all perfect examples of changes in accounting estimates, and they're all based on brand new information.
So here is the crucial point to remember. Changes in estimates are always handled prospectively. You account for it in this current year, and you move forward into the future. You definitely do not get in your time machine and rewrite history for a guess that simply changed because you got new facts. You made the very best estimate you could at the time with the information you had. When you get new information, you just adjust your course moving forward. Simple as that.
But wait, here is an essential question that trips up so many financial professionals. What happens if a company decides to change its actual method of depreciation? Say, they want to move from a double declining balance method over to a straight line method.
You might logically think, moving from double declining to straight line is moving from one generally accepted accounting principle to another, so that absolutely must be a change in principle. And technically, you're right. But the rules treat it strictly as a prospective change in estimate. Why? Because a change in your depreciation method is considered completely inseparable from a change in that asset's estimated future benefits. So we don't go back and recalculate years and years of depreciation, we just draw a line in the sand and move forward prospectively.
Section 3. Going back. Accounting principles.
Now we get to the rule of preferability. A change in accounting principle happens when you move from one perfectly acceptable GAAP method to another completely acceptable GAAP method.
For example, maybe you're changing how you value your inventory from last in, first out, which we call LIFO, over to first in, first out, or FIFO. Or if you're in construction, maybe you're moving from the completed contract method to the percentage of completion method. Now, you can't just do this because you wake up and feel like it. You have to actively justify that the new principle is preferable and that it provides a much fairer presentation of your financial reality.
Because you are changing the fundamental rules of the game here, you have to apply this retroactively. You must go back in time, and here is the three-step process to do it. First, use the new principle in the current year. Second, calculate the cumulative effect of this change for all the prior years combined. And third, you take that cumulative difference and plug it into the beginning retained earnings of the earliest period you are presenting. Let's make that concrete. Say Moody Construction switches to percentage of completion, and doing the math, that results in a historical $300,000 income boost before taxes. They don't just dump that $300,000 into this year's income. No way. They calculate the $300,000 boost, take out the 30% tax effect, and then adjust their beginning retained earnings upwards by the net difference, which is $210,000.
But we have to be super careful about what exactly we are recalculating here. We only apply this retrospective time travel to direct effects. These are the immediate, mathematical results of the change, like the actual inventory balances shifting around, or the deferred tax liabilities that change because your historical income changed. But what if changing your inventory method meant your historical net income would have been way higher, which means your executives would have earned massive profit-sharing bonuses back then? Well, those are indirect effects, and we do not go back in time to adjust indirect effects. Those royalties or bonuses, they are handled right now, prospectively in the current period.
Of course, there is always an exception to the time travel rule, and it's called impracticality. Let's say you want to move your inventory valuation the other way, from FIFO to LIFO. Under LIFO, you have to track highly specific historical inventory layers, potentially going back decades. Rebuilding those old layers retrospectively might be literally impossible because the data simply doesn't exist anymore. If it is truly impracticable, you don't go back. You just draw a line in the sand, make your current inventory your new base layer, and move forward prospectively.
Section 4. Changing the reporting entity.
Sometimes, it's not the math that changes. It's the company's actual footprint. Imagine a parent company that owns 10 subsidiaries. Last year, 2 of those were tied up in messy bankruptcies or under foreign control, so they only consolidated the financials of 8 subsidiaries. But this year, those legal issues are totally resolved, and they are back to consolidating all 10. If you just look at this year's revenue compared to last year's, it's going to look like massive, explosive growth. But it's an illusion. It's just caused by the entity itself changing. So, to ensure an accurate apples-to-apples comparison, the rules require retrospective application. You have to go back and restate last year's numbers as if you had consolidated all 10 subsidiaries the entire time.
Section 5. Fixing past accounting errors.
Okay, we really need to emphasize a huge difference here. An accounting change is when you move from one valid GAAP method to another. But an accounting error, that's when you made a flat-out math mistake in the past. Or maybe you were using a completely non-GAAP method, like doing your corporate books on a cash basis, and now you finally need to fix it to the accrual basis. This isn't just called a retrospective change, it's heavily branded as a retroactive restatement. You are fixing a past wrong. You have to restate the prior periods and net the cumulative effect of your mistake against taxes, adjusting your beginning retained earnings to completely correct the timeline.
All right, let's take a quick breath. Think of this as your ultimate cheat sheet for the explainer, summarizing all our rules of financial time travel. Change in estimate? That's just new information. Handle it prospectively. Change in principle? A justifiable shift in methods. Handle it retrospectively. Change in entity? The actual structure of the company shifted. Handle it retrospectively for comparability. And an error in a prior period? A mistake or non-GAAP usage requires a full-blown retroactive restatement. Keep these rules handy. It organizes all this corporate chaos beautifully.
Section 6. The magic of self-correcting errors.
Now we arrive at the final, and frankly, the most fascinating concept in this entire topic. What if I told you that certain hidden accounting blunders actually possess the magic to fix themselves completely over time? Let's walk through the specific math of a counterbalancing error. Imagine in year 1, you accidentally overstate your ending inventory by $5,000. Because ending inventory reduces your cost of goods sold, this mistake makes your expenses look lower, which artificially inflates your gross profit by $5,000. It looks like you had an amazing year, but watch what happens next year. Year 1's ending inventory becomes year 2's beginning inventory. So now, your beginning inventory is overstated by $5,000.
This increases your cost of goods available for sale, which inflates your expenses, which artificially drops your two's profit by that exact same $5,000. Over the 2-year span, the total combined profit is completely accurate. That $5,000 error perfectly washed itself out to a net zero effect on retained earnings.
And it's not just inventory misstatements that do this. These magical self-healing errors happen elsewhere too. If you forget to record an accrual, like say you forget your rent expense for this year, your income is artificially high. But when you finally pay that rent next year, you end up recording 2 years' worth of expense all at once, making next year's income artificially low. The exact same thing happens with omissions of deferrals, like if you expense your prepaid insurance way too early. The absolutely crucial takeaway here is that these specific errors require exactly 2 years to wash out completely. If you are sitting in year 3 and you suddenly discover you made an inventory error way back in year 1, you actually don't need to touch your beginning retained earnings at all. The math already healed itself.
And that brings us to the end of our journey through the shifting timelines of corporate accounting. So the next time you look at the financial statements around you, whether you're analyzing a hot new stock, managing your own business, or burning the midnight oil studying for the CPA exams, I challenge you to look a little closer. Are those numbers just quietly looking forward? Are they actively rewriting the past to reflect a brand new reality? Or is there a hidden error buried in there, just quietly waiting for year 2 so it can magically self-correct? The numbers always tell a story, and now you know exactly how to read the timeline. Thanks so much for joining me on this explainer, and as always, keep learning.